Look, if you've glanced at the financial headlines lately, you're probably suffering from severe economic whiplash. I mean, on one hand, Wall Street is absolutely roaring, but on the other, a simple trip to the grocery store feels like a full-blown financial crisis. So today, we're diving into this massive mid-2026 economic paradox to find out exactly what the data is hiding. The big question we really need to answer today is this: why is the stock market booming while everyday consumer wallets are hurting so badly? Honestly, if you've been feeling completely lost right now, trust me, you are not alone. The economic signals are completely crossed. But as you'll see, the latest data from Charles Schwab and the Federal Reserve actually reveal a very clear and highly divided picture. Just look at the contrast. Over on Wall Street, analysts are currently projecting a massive 25% earnings growth for the S&P 500 this year. But down on Main Street, inflation-adjusted wage growth has actually slipped into negative territory. Think about what that means for a second. While corporations are projected to pull in record profits, the actual spending power of the everyday American is shrinking fast. To make sense of this crazy split, economists use a specific term, a K-shaped economy. Picture the letter K. One arm points up while the other points down. The top part of that K represents the wildly thriving tech and energy sectors. And the bottom part? Well, that's the everyday consumer, dealing with depleted savings and a painfully high cost of living. So, let's break this down. Section 1, Wall Street's AI boom, and the forces driving the 2026 market rally. The sheer scale of this market rally really comes down to a specific group of companies known as hyperscalers. These are the massive tech giants that design, own, and operate the huge data center networks providing global cloud computing. Their relentless spending, we're talking monumental capital expenditures to build out artificial intelligence infrastructure, is literally the engine pulling this entire stock market train right now. And the magnitude of this AI boom is truly staggering. According to the 2026 outlook from Charles Schwab, AI infrastructure stocks have seen their earnings estimates revised higher by more than 50% since the end of 2024. That is wild. But here is the catch. If you exclude that AI infrastructure from the S&P 500, earnings estimates for the rest of the market have actually moved down slightly. Which brings us to a major vulnerability in Wall Street's boom. It's what we call narrow breadth. Right now, only about 17% of S&P 500 stocks are actually outperforming the index itself. So it's basically a high wire act. The market's overall success isn't broad-based at all. It's incredibly concentrated in just a handful of high-momentum AI and energy names. If those specific sectors stumble, the whole market feels the drop. Now for the other side of the K. Section 2, Main Street's inflation pinch, and why the average consumer feels left behind. A massive piece of the puzzle here is geopolitics. The unexpected US-Iran war and the effective closure of the Strait of Hormuz have created a severe global supply shock. This has caused energy prices to absolutely soar, which rapidly increases energy's contribution to overall inflation. This is a direct, painful hit to your wallet, at the gas pump and in your utility bills, a reality that entirely bypasses whatever the heck is happening on the stock market. But it's not just energy. We also have to look at what economists call supercore inflation. This metric strips out volatile things like energy, housing, and tariffs to show us the baseline cost of everyday services. And right now, it is incredibly, frustratingly sticky, sitting stubbornly above a 3% year-over-year pace. The baseline cost of living just refuses to budge. Headline inflation might be sitting at 3.5%, but that sticky supercore inflation refuses to drop below 3%. Meanwhile, the Federal Reserve's long-term target is way down there at 2%. We simply aren't getting there, because the cost of everyday services, combined with those soaring energy prices and the AI-driven tech demand, is keeping the floor on inflation uncomfortably high. This leads directly into Section 3, rising consumer debt distress and the cracks in the household balance sheet. The Federal Reserve's recent financial stability report highlighted some very real cracks starting to show up for everyday Americans. While prime borrowers are mostly doing fine, auto loan delinquencies are staying well above their historical median. Credit card balances are creeping steadily higher as people try to make ends meet. And we're seeing rising distress among borrowers who recently bought homes with low down payments, specifically in FHA and VA loans, as their equity cushions evaporate. Now, take a breath, because this is not a repeat of 2008. Whether you look at it relative to market value or model-implied values, overall outstanding mortgage balances remain significantly below their historical peaks. So while niche areas of consumer debt are definitely hurting, the broader housing market isn't wildly overleveraged like it was in the past. So who fixes this? Section 4, the Fed's Balancing Act, navigating the cross-currents of 2026. As of mid-2026, the Fed has kept their benchmark interest rate steady at 3.75%. Because headline inflation fell slightly to 3.5% in June, they've paused. But thanks to that sticky supercore inflation and those wild energy shocks, the deep rate cuts everyone on Wall Street was hoping for earlier this year, yeah, they have completely evaporated. And the messaging from the top is crystal clear right now. Speaking in Portugal recently, Fed Chair Kevin Warsh stated firmly that delivering price stability remains the Fed's primary objective. Despite market hopes for easier money or heavy political pressures, Warsh is making it known that getting inflation back down to that 2% target is the ultimate priority. Basically, the Fed is trapped in a massive tug of war. On one side, they have upside inflation risks fueled by monumental AI infrastructure spending and those energy shocks from the Middle East. On the other side, they face downside economic risks, namely an exhausted consumer facing negative real wages and rising debt delinquencies. It's a brutal bind. Cut rates and inflation might spiral out of control, raise them, and Main Street breaks. So where do we go from here? Section 5, what to watch next, and the fragile assumptions of 2026. Right now, Wall Street is pricing in a smooth, multi-year AI ramp-up. But that entire assumption relies on a highly fragile semiconductor supply chain concentrated in Taiwan, South Korea, and the Netherlands. Any geopolitical disruption there could completely derail the 25% earnings growth Wall Street is expecting. Combine that with ongoing energy shocks and a consumer base that is increasingly reliant on credit cards just to survive, and you have a recipe for sudden, immense volatility. Which leaves us with one final, deeply important question to consider. How long can a booming Wall Street truly coexist with a strained Main Street? Eventually, these two realities will have to reconcile, whether Wall Street comes crashing down to meet the consumer's reality, or the consumer somehow catches up to the market's optimism. Well, that is going to be the great economic drama of 2026. Thanks for joining this explainer. Keep a close eye on the data, and we'll see you next time.